because I think it'll be a bit easier. So as long as you can all hear me, that's great. We're going to have the same clicker problems. So a little bit about me first. So as mentioned, my background is quite traditional retail. So I started off as an accountant, and then I've worked at places like Kingfisher when it was a bigger conglomerate. A lot of you won't remember. Argos, I was set Tesco Direct up for Tesco, ran a couple of businesses, M&M Direct and one called Ashika, and was customer director at B&Q. But for the last couple of years I've been working building out OmniCommerce. So there's 6 of us, over 30 clients. We've got a whole range of businesses from startups up to Accor Hotels, our biggest client, so 4 billion turnover hotel chain. We're global, so US, a lot of Europe, not quite out in Asia yet. We doubled every quarter in 2021 in terms of size, and all through word of mouth. So we've only just started really doing some outreach. And the things that we do is we offer SaaS insight products, we do insight development, insight consulting, and we help VCs and PE houses use insight to improve their decision making on entering a business. So what I'm going to cover off today is a quick intro around BI and insight and my views on that. A little bit of interesting stuff on visualization theory, some of the tools that I recommend you should be using, one in particular actually, and then some techniques, and then I'll just wrap it all together at the end. Oh, back one, it worked that time. So, first, a couple of things first. So, you hear a lot of people talk about big data. It's not new, right? It's just bigger data. So back 25 years ago when I started out in retail, it was a super drug. We built a data warehouse. It took over an entire room, and it was doing by SKU, by day, by store, and there were 700 stores, and that was relatively big data and analytics at the time. But the techniques are still the same these days. It's just the data's got bigger. So with clickstream data, you've got sort of almost infinite bits of information about what's going on. So, you know, big data and data isn't new. It's just bigger than it was. And customer insight isn't new. So obviously people are obsessed, and you'll see some stuff in a minute about customer lifetime value. But the reality is the guys in the old school catalogue retailing have been doing this for 40, 50 years. They didn't have stores. All they had was the data about what was selling on what page. So they were the sort of forebearers of actual modern customer analytics. So customer insight isn't new. The thing that is new really is the democratization of insight. So those bits of BI that perhaps were the sort of things that I used to get when I was running businesses at Tesco or in B&Q, you know, they're available to everyone in this room these days, and at a fraction of the cost that they used to be. So what it's meant is the stuff that was available for much bigger businesses is now available for pretty much all businesses, and I'll show you some stuff around that in a second. Next slide. So this is a grid that we use when we measure the maturity of businesses in their insight journey. So basically along the bottom is how widely it's used in a business, and along the left how sophisticated. Most businesses it's not used very widely and it's quite simple. Slightly more dangerously, there are some businesses that we come across where it's used everywhere but it's a bit simplistic. Probably slightly more common is you have a talented individual in one team in an organisation who's good at insight, and so they're doing some really interesting stuff, but it's not dispersed throughout the organisation. And very rare do we come across businesses where insight is intrinsic in everything they do. And the world-class businesses are certainly up in that quartile. And with all the businesses that we come across and we work with, it's very rare that we get introduced to one where they can generally say they're in that top corner. Next slide. So, and the reason for that is you need 3 skill sets, and those skill sets are a technical expertise to know how to get hold of all the data you need, clean it, and join it together. You need analytical techniques once you've got that data to transform it into insight, and finally you need financial acumen to align all of that with how you as a business is going to make more profit or create more shareholder value or stakeholder value. And what you tend to find is, again, you either need an individual who's good at all of these 3 things, and they are so rare. I can tell you I've probably met 2 or 3 in my career, and I've worked at quite a few places. Or you're reliant on teams, and what tends to happen is the IT guys tend to try and do very strategic solutions and not too tactical, but they don't necessarily understand the other circles. The sort of data scientists sometimes aren't particularly good at the technical side, but they're very rarely have they got a financial acumen, and the finance guys just want everything to reconcile to the last penny and will get obsessed with that rather than getting good quality insight out of it. And that's generally why we've got a business, really, is the fact that these skill sets are so rare, and that's why most businesses aren't in the top quartile. So next slide. So this is just a quick example of also how, as businesses get bigger, the complexity means that you need more insight. So there are, I'm not a pilot, by the way, but there are 6 instruments you need to fly like one of these little small Cessnas. Altimeter, airspeed indicator, vertical speed indicator, attitude, heading indicator, and turn coordinator. So if you're going to jump in a little Cessna, you've got one lever, a couple of buttons, and away you go. Next slide. This is what you need to fly a 747, right? It's much more complex, more instrumentation. You still might be using 5 or 6 of them, but as the thing that you're piloting gets more complex, you need all of these things, even if you're not going to be looking at them all the time. So you still might have 5 or 6 key indicators that are the key to you, but the fact is there's a whole array of things that you need to do if you're really optimizing your performance as your business gets more complex. And to sort of prove that point, this is something I drew a few years ago now. And not expect you to read it. It's the anatomy of paid search in Google paid search. So these are all of the component parts that you would need to be looking at to optimize paid search in your organization, ranging from some of the stuff around ad rank and quality score right the way through to customer lifetime value. So just in this one diagram alone, you can see how perhaps focusing on CPA or CAC is it's a great measure, but actually there's so many different KPIs that you could be looking at to optimize your performance that it can get quite complex. So moving on now to some stuff around visualization theory, and these are just some things that we use at OmniCommerce to sort of guide us when we do stuff. Next slide. So we sort of have a mission when we come up with our insight, and that is that our insight should be concise, our insight should be consistent, and it should be convenient. So don't make it complicated. Basically make it as consistent as possible so people have a reference point whenever they're looking at things across multiple different forms of data. Always make sure things are in the same place and navigated in the same way. And convenience is normally basically, can I get to the next level down from what I'm looking at as quickly as possible? And there'll be some examples of that later. And to help with that, we pose 4 questions really when we're creating dashboards and stuff. So what's happened? What's caused it to happen? How long has it been happening for? And is there anything being masked in aggregation? So quite a lot of times you'll see a KPI that looks okay, but if you delve the next level down, there's some variety in that. And again, we'll show more about in a second. So if you're producing any analysis, just ask yourself these questions. And a good example of the one around how long has it been happening for, if we go to the next slide, basically this is a pie chart showing the percentage of customers that have placed a certain number of orders, so 1 through to 10 plus. So I hate pie charts, and the reason I hate pie charts is it's such a snapshot that it can tell you something, but it's not telling you everything. This chart on the right hand side is basically 100% is the bar, and the participations of 100% is the different colours within that. But it's giving me so much more than the snapshot of the final year. It's showing me the context of that against all the other years. So something as simple as that will take what probably is clumsy dashboarding and putting a pie chart on and basically give it a lot more context and make it a lot more usable for people to use. And there's a lot of theory around visualization. So there's some, and you can Google this if you want to, there's some stuff called the Gestalt principles of design. There's something called preemptive attributes, which is to do with iconic short-term and long-term memory. So all of these things are very, very theoretical, and I'm really reticent to start putting some of those up. So, because I think they're quite complicated. So what we do at OmniCommerce is we boil it down into 7 things that you can do in design to make a difference, and it's a bit of a combination of both of those. So first of all, on the next slide, we look at position. So I'm hoping that even in this visualization, you see a load of dots here, but the dots on the left-hand side, I'm hoping you can see you would read across, and the dots on the right hand side you would read down. And that's just to do with the spacing of the dots, and it's just the way that the brain will visually read stuff. Next slide. Another example of that, same shape, different directions, right? The orientation of the product. So this is all to do with positioning and orientation. Next. Dimension, obviously as something gets bigger you can represent scale. It's got to be a little bit careful with dimension. Obviously the diameter of these circles increases, but the space is much bigger, so you've got to be a bit careful with dimension, especially when you get into sort of area and volume, but you get the point. Next. Form, so you can see here that we've got some dots, and we've also got some squares, and you can differentiate between those. But look at what happens on the next slide when we switch that to colour, and much more easier. So again, not a big fan of using sort of bars in bar charts that have different shapes and stuff on them, because they're really hard to visually use. Much better to use colour if you can. Next slide, enclosure. So again, quite easy to identify the things that have been enclosed and the things that are outside the enclosure. And the next one is connection. So again, we're connecting those dots together and creating a relationship with them. It could be really interesting. If you look at something, imagine something like a scatter chart with loads of random dots on it, and then you plotted them in the order of which, say, a time series. It will create a completely different chart, because you'd have you'd have a line that's sort of maybe spiraling around the page rather than just a whole of random dots. So connection can be important. And then finally, and wait for it, movement. Not a big fan of movement and animation. I think if you're using that, it's probably because you haven't done a good enough job of making the stuff clear through the other things that you can use. So I would tend to avoid that. So I've got a little test for you to make sure you're all still listening and awake. So I'm going to put a grid of numbers up for 4 seconds, and I want you to try and count the number of fours that are on that chart. And I'm going to have to point at you to change the slide when I put it on, so that it's only there for 4 seconds. So here we go. And off. God, yeah, 5, 6, 7. Still, I'd imagine there's not many people who got all the fours on there. Anyone think they might have got them all and scanned it? Okay, we're going to do the same exercise again. Oh, no, the next slide after that one. Oh, there's some colour gone from there.
Now we got the all.
Oh goodness, yeah.
So, I don't know what's happened when the slides were copied over. Basically, the fours were highlighted and you'd count them very quickly. So I don't know what's happened to the colour formatting on that screen. So that's completely blown that. But basically, the point is, when they're highlighted to you, you'll get them instantly using colour. So yeah, not sure what's happened there. Oh, maybe it's this next one. There you go. So basically you would get them within seconds, right? And that's the difference, is your brain scans using the colours and you do 1, 2, 3, 4, 5, 6. So there were 6 in the end. Keep going. Great. So final couple of tips. The first is use white space. So I have seen quite a lot of dashboards that are built with dark colours behind them. I'm not a fan of them. The reason for that is, you know, we've been used to reading stuff on a white background for thousands of years, and 99% of books that are written and people read have got white behind black text, right? So why you would ever want to go away from that, you'd have to be very smart to do that, or very confident in what you're doing. Same colour, so use colour, but don't use too many colours. So there are other ways of differentiating things. If you've got too many colours, it will confuse the brain. The third is less is more. So I'll misquote someone who once said, you know, I would have summarised it, but it would have taken me longer. The fact is, as you try and make things more simple, it's more complicated to do that, but it can really help the user. And finally, no 3D at all, because it can distort the view of things, and no pie charts. Next slide. So tools. There are, next slide, a number of different BI tools that you can use. So obviously Microsoft Power BI, Google Data Studio, which is free, and if you've got a bit more money, Tableau, Looker, and ClickView. So I prefer, next slide, Power BI, a bit of enclosure there, and I'll explain the reasons why I prefer it. So there are five reasons. So The tools that they give you to prepare the data are outstanding. The second one down, the data manipulation language that you can use is a Microsoft language that's been around for a while. It's very advanced. They've got great visualizations. It connects to all the other Microsoft products and it's cheap. Again, not expecting you to read this. It's just an example of the query editor. So what you're able to do is pretty much point at most data sources and create a number of different steps through a really easy to use user interface where you can take columns, extract data from it, parse data from it, format it, and basically you just work through your rule-based transformation in a number of different steps, and it's incredibly easy to use. So if you haven't used it yet, have a go at it, because it can certainly save a lot of the manipulation that people do when they get hold of spreadsheets that aren't in the right format, even just to get rid of the top few rows, etc. If you're slightly more sort of technically minded, those different steps actually behind that it creates a language-based set of those steps. Is something called mQuery. So if you're very advanced, you can do some very clever stuff with mQuery, but you can use the query editor just as well. Next slide. So DAX, which is once you've got the data in a position that you want to use it and you load it into Power BI, DAX is the language that you write to create the calculations. Again, this looks quite complex, and it is. It's a calculation to work out the cumulative running total of some revenue. But if you go on to the next slide, and if I would write something in DAX, I wouldn't use what I'm about to show you. So this is a set of quick measures that basically Microsoft have put into Power BI, where basically say, right, I'm interested in rolling average. You would click on that, you click the fields that you would need to populate in it, and you can create those DAX measures sort of cleverly through just basically plugging in some gaps that Microsoft tell you to plug in. So you don't need to be a programmer to use it. It's very, very easy to use. Next slide. There's a whole host of out-of-the-box visualizations that come, but underneath this dotted line, I've loaded here some custom apps that individual companies build. Some of them are free, some of them have extra functionality. I don't tend to pay for most of the things that I use. And there's hundreds and thousands of those customized visuals, and there's a bit more being added all the time. And all of them have a huge amount of customization, and increasingly you're able to create functions to do those customizations. So, for example, even if you wanted to change the color of an axis to be red rather than black for a certain reason, you would just put sort of a calculation in to say, if this happens, change the color to this. It's very, very clever and very customizable. Next slide. And the final two bits, so Microsoft connectivity. So if you're users of Microsoft Teams, it's increasingly seamless between Power BI and Microsoft Teams. And finally, it's cheap. So the version of the desktop of Power BI is free, and if you want to share it amongst a couple of you, those licenses are under $10 each. So, if you think back to, products like Tableau that could be hundreds of thousands of pounds per year, this is what I mean about accessibility. The ability for you to have a world-class insight tool that you can use for less than $10 a month is insane. And the stuff that I'm doing on my laptop today is dealing with sort of 40, 50 million rows worth of data for some clients on my laptop with a $10 a month tool. So it's completely unlocked the ability, for me to grow my business actually, because before Power BI, I would have needed a team of developers. I often get asked, where's your development team? And I'm saying, you're looking at them in the old days, because I built it all myself from scratch, and I wouldn't be able to do that without Power BI for sure. So some techniques, so some real life examples now to take some of that stuff and show you the techniques. So this first one is very important. It's called customer accounting. And so what you do is you basically take the revenue of your business and you break it into a calculation, which is how many customers did I have last year, what percentage of those have I retained, so what's the total amount of retained customers, plus new customers is the customers this year, times frequency is orders, times average order value is revenue. Seems quite simple, but that sum is basically applicable to every business. And then if you go a bit further down, you can sort of model things like the customer acquisition cost and the cost per order, but I've just stopped at revenue. And so if we look on the next slide, you can see a real life example of this data. So how many customers did I start the year with, which incidentally is how many that I would have finished the previous year with. What percentage have I retained? How many have I got new? So that's the total number of customers times frequency is the total orders times average order value is the revenue. But the great thing about that in the next slide is that you can plot those on a rolling 12 months basis on a chart. So this is basically the 4 KPIs that really matter there are your new customer rate, your frequency, your retention, and your average order value. Everything else will be basically calculated on the back of those 4. And so what we're seeing here is a trend of new customers on a rolling 12-month basis, some dips and some peaks. Rolling 12 months is really useful because it gets rid of seasonality normally and the oddities of certain weeks. So the frequency you can see for this business, and this is real data, has been increasing slightly. Retention rate bounces around a bit, but it's hovering around 11%, and average order value has been increasing quite nicely but flattened out. What I can do is I can extrapolate these out over the next 12 months and say, if my new customers is 1,800, my frequency is 1.29, my retention rate is 11.5, and my average order value is 79 quid, I'll grow at 6%. So it's a really quick way of basically saying, right, okay, what if I had 2,800 customers, what would my growth rate be? What if I focused on getting my average order value up another £2? What difference would it make to the revenue? So very, very powerful tool, customer accounting. This is also really interesting and something we focus on quite hard at OmniCommerce. So if you take a cohort of customers, so let's say customers that you acquire in this month, in June, on average, all of those customers will place just over 1 order on average because some of them will come back, right? It ends up, all businesses will be different, but it's normally 1.05 or 1.1. If you look at those bunch of customers again in 5 years' time, they will have a multiple of that. So you take all of their orders over all of their lifetime and divide it by the original cohort, it will be a multiple of 1. And for all different businesses are different, so it can be as low as 1.5, 2 for something like if you're selling like a business that I was involved in, like bed linen or mattresses or something, and if you're doing subscription dog food, it could be 20 or 30 times the transactions over the life. The more data you have, it's basically a curve, because any way you can join those 2 points, 1 and a bit and a multiple of 1, is a straight line or a curve. It's never a straight line because of the law of diminishing behavior. So it's always a curve, and we can model those curves. So this black line is an actual business's cumulative number of orders for a cohort of customers. And you can see how relatively predictable it is. I mean, we probably could fit the curve slightly better, but the reality is you're looking at the range of that over time. It's not going to do that. It's going to do something very similar to this line. And so with a huge amount of predictability, actually with only a few months worth of data, we're able to say that this cohort of customers is going to have just over 8 orders over their lifetime. And where that becomes really powerful is you can start to use those curves to model your profitability. So you know how much it costs you to acquire the customers, you know how many there are, so that's the total marketing cost. You know the profile of orders over the 5-year period, you know your average order value, you know some of your costs, etc. So what we do a lot with businesses is model those profitability curves, and often what you find is there is the ability for most businesses to push harder. So if you take a multi-year view of your growth, you can basically afford to acquire more customers and spend more per customer to acquire them. So on the next slide, this is a lot of lines on here, but this is actually the cumulative profit of lots of different monthly cohorts of customers for this business. This is the DNA of value creation. If there's businesses out there that aren't looking at this, you are leaving significant amounts of money on the table if you don't understand this. So basically, it's showing you for each of these cohorts, the longer the lines, the older the cohort, how much money did you make or lose in the first month, and then over time, how do you cumulatively, because obviously the marketing cost in many cases is a one-off cost at the start, but you can also model in subsequent orders if you want to. But what is the profitability of that cohort over time? And what's interesting normally is, a lot of businesses that I see, they basically start off and then just a very sort of flat and very pedestrian. The ones that I see being more successful have this sort of profile more where they're investing more to acquire customers, maybe losing in the first month, and basically having a much steeper curve. What I would say, take something like, I'm not a big fan of necessarily Deliveroo, but you run these numbers on Deliveroo and sometimes you think they're never gonna make any money because basically they're their cost to acquire, if you look at their commission, the average customer is going to need to place 20 or 30 orders over their life. And that's the average. Some customers only place 1, so that means the others will have to place 60, and then the numbers don't stack up. So when you start to look at this, it's very enlightening. Just another example, the Eve mattresses, right? Eve mattresses, they were spending £350 to £400 to acquire a customer of a mattress. They weren't making that money on the mattress. You don't buy, or a very small proportion of people buy another mattress, right? So hence why those guys are struggling.
So how do they make money?
They don't. They don't. They've never made a profit, and they're up for sale now because they never will make a profit. And the reason that they raise money, and because people don't understand this, so they go out and raise money, and people don't understand. The market gets overexcited and the herd mentality. But if you actually step back and look at it, they were never going to make any money. And it's I wish I shorted their stock. It started off at 80p. I think it's now at half a p, right? So it's a worthless business. It was worth hundreds of millions when it floated, just because people don't understand. Sorry, I have one anecdote. I sold a business to another business, and we took equity instead of money. And basically, that business, I ran their numbers using the stuff that I know, and they just raised 10 million. I said they're going to need 30 million to get to break even. And all these investors said to me, "Oh, what are you talking about?" I think they'd had an investment from someone like Goldman Sachs. They said, Goldman Sachs have checked these numbers, so if they think 10 million is enough, 10 million is enough. Business went bust, got sold for nothing, right? And our share got worth nothing. So it's completely telling, but there's so many people who aren't using it to make investment decisions. It's crazy.
Sorry, I'm interrupting you. Is it okay if I ask you a question?
Yeah, that's fine.
Okay, so this is something that I'm dealing with myself. The cost of the CPC is going really high these days. Compared to a couple of years ago, you could easily advertise on Google and make a sale and still be profitable. But these days, with the high cost of CPC on Google, even Bing, Amazon, for some keywords I pay £2, £3. If I'm not careful, sometimes I have to pay £7 for one keyword on Amazon, So it's really difficult to make money these days after all these marketing costs. So what's your advice?
So I'll give you a couple of
companies.
You sell a range of different products, or you sell quite a singular product?
Range of products, unfortunately.
Okay,
you can answer that question, and then we're going to keep questions to afterwards. Yeah?
Okay,
Sure. Thank you, sir.
So no, that's two things then. Are you treating the UK geographically any different, or are you doing the same thing across the whole of the UK?
The whole UK, same thing, yes.
So you'll have massive variances in different types of population centres around the customer lifetime value. And the second thing, that will vary by the type of product that you're selling. So if you took your products and looked at the lifetime value, some will have a greater level of repeat purchase than others, and you can afford to acquire more. So this is all about getting down to the granular level of detail and when you're flying the jumbo jet, rather than looking at a single KPI when you're flying the Cessna. But I'll chat to you about it at lunchtime.
Thank you. Cheers.
Here's another interesting visual. So these are all post-out codes polygons. So I live in Southampton, so my post-out code is SO16, so the first part of the postcode. And this is a business I was involved in, so this is revenue, and the intensity of the colour is basically the intensity of the revenue. You can see around Southampton it's a bit higher, but often you can see some pretty interesting visual differences much quicker than you can see the other stuff. And we've done stuff like map TV regions onto this and all that sort of thing if you're running TV. Next slide. But perhaps more interestingly, this is an example of a technique where we're now bringing together different bits of data from different sources. So these are all the customer KPIs associated with this business by postcode that's come straight out of Shopify. I've linked that with the locational hierarchy that exists somewhere, which is won't be too easy for you, but you can link it to that to create the hierarchy in the country. But also we've got population data for those postcodes. So what you're able to do is look at your penetration of your business in individual postcodes and the customer lifetime value variances across different locations. So often we're working with companies where, even let's just take this is a real business. So in Surrey, the overall penetration of customers is 3 per 10,000. You can see here in the top one here, which is Brockham, it's 9, so over-indexing. Down the bottom here in Cranley, businesses get bigger, they still exist. Next slide. If any of you working in Google, quality score used to be and still is to some extent a very key metric to look at. I even see it quoted on Google's website on one page where it says, don't use quality score as a measure like a KPI. And then on another one, they said it's really important to look at the things behind quality. They're very opaque about the topic, but it's known to be one of the key determinants of where you rank on the page and how much you pay. And so a couple of techniques we use here. So this is just a strict average across all the keywords, and this is a cost-weighted average. So where am I spending money against keywords? If I'm spending a lot of money against a high-quality score keyword, the maximum you can get is 10. That's a great thing. And so the cost weighting is just a technique that we've used to look at a sort of overall KPI, and this business has been as high as almost 10, which is perfect. But the key is there's 3 elements that make up a quality score: ad relevance, expected click-through rate, and landing page experience. And there's 3 factors that Google give you for those, and it's not so easy to get hold of them these days, but they still exist. So above average, average, and below average. And what you can very visibly see here through looking at those 3 factors and the 3 ratings is, for example, this dip here that's occurred in about May of 2021 is predominantly due to a dip in expected click-through rate from above average to average. So again, visually, very quickly getting to the heart of what's going on. Next slide. And here's another. It's one of my favourite charts. That sounds a bit geeky, but it is. So we were the first people globally to work out that there are 27 combinations of the 3 ratings and the 3 factors, and they all map onto a quality score. And that led us to design this report, which basically shows very visibly for this one keyword. It starts as a 10, and then sometime in February of 22, it drops down to an 8. And you can see here the ad relevance has been above average all that time, expected click-through rate above average all that time, landing page experience gets to Feb and drops from being above average to average. So instantly you can see how that quality score has been impacted by that particular factor. Next slide. Also within our paid search stuff that we do, we work a lot with the assumption that if you've got a number and that number is made up of a calculation of other numbers, you can basically break the variance in that number into the movements in those component parts. So in this particular case, your conversions are made up of how much you spend divided by the cost per click, which equals clicks, times the conversion rate, which equals conversion. And when you've got that over 2 time periods here, year on year, what you're able to do is take a whole host of conversions year on year and break it into the 3 drivers of that. Again, this is real data. So what this is showing is a massive decline in the number of conversions, but you can see a positive spend variance. Basically, that this business is spending more money and it's creating more conversions, being offset by higher CPCs and much lower conversion rates. And often, I know there's some agencies in the room, often when people go back to an agency and say, right, I want to spend more money, I want to drive the business harder, if it's not done in a smart way, what happens is you see this mirror effect of more spend but higher CPCs, and in some cases, if you're spending it in the wrong areas, worse conversions. But it tells the story of what's going on much more clearly. Next slide. This is some Google Analytics data. It's a very simple visual. All it's showing is year-on-year revenue. So it's basically showing it across all the channels and actually by device. And what you're seeing, so you look at something, it's showing across all of them a level of materiality. What you can see, the most important variances seem to be coming out of paid search. You can see they were positive right the way through to this point where they spent negative. In fact, April was a bit of a disaster. So that in itself just very visually gets you to the trends much more quickly. And you can see then we've got the same by device. Interestingly, the desktop and the mobile things that are more variance than the tablet, obviously, because the numbers are much smaller. If we go on to the next slide, though, there's another technique. So we've taken again that calculation approach where if a number's made up of a calculation, you can break it into component parts. So sessions, less bounce rates, gives you what we call intent sessions actually, times the conversion rate that will give you orders, times average order value giving you revenue. So when you look at revenue year on year, you can break it into 4 component parts: traffic, bounce rate, conversion rate, and average order value. What we're seeing here is for this business, the revenue is up 48,000, but you can see there's a negative variance of 21 attributable to sessions, and that's pretty much equal across all devices. You can see there's a positive bounce rate, so bounce rate would have been lower. You can see conversion rates flattish, and you can see there's a big gain here in average order value. So instantly telling the story of the revenue growth. And then when we look at it by channel, this is one of those points around, is there something that's being aggregated that when you take it out, will show you something. You know, this bounce variance looks pretty good, but you can see it's purely driven by paid search, and the bounce rate is down across all the other channels, right? So just a good example of that. And then, again, an example of the convenience within analysis. If you go on to the next slide, you can take that paid search line, and if you click on it, it would then basically subdivide the device into that paid search. So here you can see that the numbers at the bottom are now just reflecting paid search. And again, if we look at the different KPIs like sessions, actually mobile's down, tablet's down, but desktop's up. And again, it's about looking at the component parts. Next slide. This is another visualization that we use out of the box from Power BI. It's a calendar, and you can see basically the intensity of the color. What we've created here is a tooltip. Now, I'll be critical of our own work here. Those lines should be a bit darker to make it easier to see. But the fact is, you're instantly seeing through the intensity of color, the busiest days is Black Friday weekend, it was a Sunday, and you can see very clearly that we sent an email out and then the business started to tail off. So instantly, in one hover, you're getting the next level down of what happened on that day. Next slide. The reason I put this up, so here's some categories that this business sells, and it's got sales and margin and the cash margin in the year. But again, we've broken that into another technique that you can use, which looks at mix. So you can see there's a positive sales variance, there's a slight margin variance, and there's actually a small negative mix variance. So mix, if you've got any group of things that change in participation and have a widely different margin percentage, for example, then there'll be a mix effect. So in this particular case, the duvet covers are 82% up. That's above the average growth, so they're growing faster than the rest, and they've got a lower than average margin. That's why they've come up with the negative mix effect. Can be really useful when you're looking at margins, also quite useful when you're looking at conversion rates, because as more traffic's moved to mobile, they have a lower conversion rate from mobile, and some of your revenue can be attributed to the fact just of the shift into the mobile channel. Next. Another technique that we use in our sort of Shopify trading suite with WooCommerce, etc., all of our trading packs is basket analysis. So this is showing which categories get bought most commonly with other categories, so the percentage of times and the value. So go back 25 years when I was at Superdrug, a very good friend of mine, her job was, full-time job, was to produce this chart. That's all she did. She used SPSS, which is an old stats tool, some you might have heard of. That's all she did for her job, is this one chart, full-time. So, and this is now out-of-the-box functionality for people. Next slide. And then the final thing here, it's a bit similar to the other one, but what I've put on here is basically, if you, this point around connecting the data together, if we take, for example, cost of sales from Shopify, which you can put in, and we also take weights from Shopify, and we enable you to basically calculate an estimate of profit. And we do that by taking every single order, and we say, right, was there a discount on that order? We'll spread that across the products in proportion to their value. You know, was there a delivery income? Again, split that equally so they get their fair share of that, but then take the cost of the product, and then take the weight times some assumptions you can make for shipping and pick and pack, and come up with a profit estimate. Once you've got item level profitability at an order level, you can aggregate that up in whatever way you want to. You can have category profitability, customer profitability, look at profitability over time. It's hugely powerful. Next slide. So, a lot to take in there. I've come to the end, including an unfortunate demo on the numbers that didn't quite go in the same order, but in terms of some conclusions, some stuff to leave you with, really. So, first of all, I've said it's attainable, but it is still really hard, and you do need to work at it. But the great news is the tools exist for you to do some of this stuff. Even in Excel, they actually have a version of the query editor I showed you where you can bring data in and manipulate it. So if you haven't used that yet, it's sort of bulk standard Microsoft functionality. What I would say is just think a bit harder around when you're producing dashboards and visuals. It's so easy to go down the default options that are in the sort of graphing in Excel and choose some horrible 3D with some formatting that's awful. Just think about it and boil it down to what's the simplest one I can use and work that a bit harder. And to that point, less is more. So when we build, I've got a client that we've just pitched for some work for, and he said, look, I'm pulling all these data together from Shopify and Google Analytics, and I'm going on holiday and I'm the only one who can do it. Can you replace it for us? And I said, yeah, fine. Send me to it. It was an A3 sheet of charts and tables. I mean, it was just insane. I don't know anyone would be using it. And we're like, well, look, you've got to break that down into manageable chunks and some hierarchy. So less is more normally. Test, always learning. The biggest privilege that I've had, having worked and collected some techniques over 25 years, in the last 2 years, is to work with 30 or 40 businesses on their individual challenges. And I'm always picking up new ways of looking at things. Even the cohort curves was something that came to me about 18 months ago. So, continually learning, continually testing, continually trying to work out what works better for customers. And then I would say this, but if you need a bit of help to get to world class, we can help you do that. And some of our stuff is out of the box, so we can get there very quickly and cost effectively. So that's me done.